But let's welcome in Pankaj Murarka, who's now with us. He's a veteran, seen many cycles, CEO and Chief Investment Officer at Renaissance Investment Managers. Pankaj, good morning. Great to have you with us here. Thank you for your time. Intense debate on at least social media on what to do with small and mid caps. I'm sure, I don't know if you followed all of it, but I'm sure it's kind of tough to miss. What is your sense? I mean, I think generally everyone is in agreement that maybe things got overdone quite a bit on the upside, and now, of course, many stocks are paying the price, but it's always like that. But what is your sense from here, Pankaj? Because markets will look ahead, trying to price in what's coming 3-6 months down the line, not look back. So that's the question to you.
Morning, Prashant. Well, Prashant, we need to acknowledge or concede the fact that we are 5 years into this bull market. After 5 years, you don't get low-hanging fruits. And if you have a ferocious bull market like the one we've had in the last 5 years, obviously there will be pockets of excesses. And this time around, we have had excesses across the board, and largely more than we've had our excesses in mid and small caps. So I think we're going through a process of mean reversion, but which is classical of any market cycle in that sense. I think over the last 8 or 10 weeks, we've seen meaningful, mean reversion or pullbacks in prices, especially in mid and small cap. It's been slightly more amplified in that sense. I think the challenge, if you ask from my point of view, is more on the small cap side than on the mid cap side, because one, valuations are pretty rich there. And more importantly, what concerns me more is there are a lot of companies with, where business models are untested for economic cycles, economic crises. They have fragile business models, and markets have given them valuations which certainly do not tie with their long-term growth prospects. Markets probably are assigning multiples basis currently growth over the next 2 or 4 quarters, and we know that the long-term growth for a lot of these companies will be much lower. And in many cases, the business models, as I said, are untested. And when markets go to that extreme in terms of giving high multiples or high valuations to those kind of companies, obviously there'll be some pain there. Having said that, I'm not so negative on an aggregate basis if you take a 1-year view, because I still think what will make money from here on is bottom-up stock picking. So if investors are focused, there are still enough ideas there on a bottom-up basis where one can go out and invest and still make reasonable or healthy returns over a 1 year to 3 year time horizon kind of thing.
By the way, I just want to point out Eicher once again. The pressure is unrelenting on Eicher Motors, almost 6% down. And you would argue what's so wrong, because the top line was more or less in line with estimates. It was not too far off. But the margin fell a little more than what the street had penciled in. The margin year on year is down almost 200 basis points, 190 basis points to be precise for Eicher Motors. And the street just doesn't like that. Plus, there's no price increase either. So it seems that, that's the reason behind the punishment the stock is getting today. Pankaj, great to be speaking with you this morning. Good to have you on the show. So, thinking of Eicher, I was just wondering, how does one play the consumption bonanza that came through in the budget? And I think the consensus that we got was that it will be rather spent on discretionary items than sabun and tel, so to speak, right? What's your thesis around it? So, when you find, whether it's autos or home improvement or even, leisure and hospitality, would these be some pockets that you would look at?
I think consumer durable looks more better place to be benefiting out of the tax rebates that the government has doled out in that sense. And I'm hoping that some part of that will certainly trickle down to staples as well. The fact is that we are in the middle of a sharp consumption slowdown. Rural consumption has been slow or sluggish now for almost 7 quarters. Urban consumption has been slow for almost 4 quarters. A lot of meaning something like apparels, a lot of broad categories have seen negative growth or very modest growth in that sense in the last 4 or 6 quarters. Apparels have had a negative growth, organized apparel, which is pretty surprising because we don't see negative growth in apparel so often. So I think from the overall landscape, probably consumer durable is one segment which looks like should be a beneficiary of that probably in the second half of this year as we see revival in the consumption. And I also think that we'll see some recovery in staples as well, because the growth or volume growth in staples have been very modest over the last 3 years. But probably now income levels should catch up with the sharp rise in inflation that we have seen in the last 3 years, and we should see some recovery in staples as well.
Just on consumption, a follow-up. What kind of a multiple would you be willing to give to some of these consumer platforms / internet companies, right? With the Swiggies and Zomatos of the world. And I mean, you spoke about retail. I could also ask you about Trent, which was the poster boy. I mean, consumption stock, a retail stock trading at 90 times, 100 times forward earnings. But so much has changed over there as well. So, any other pockets of discretionary that you would consider where maybe stock prices are coming now more in sync with reality?
Yeah, so on the platform companies or the new age companies, I think the challenge there, valuation is not, they will always be priced richly because markets would look at longer term value because it's a space where winner takes it all. So, and generally in in the internet space, generally the trend is that, the top 2 or 3 companies makes 120 or 150% of industry profits because all the other players lose money. So the nature of the business itself leads it to a oligopoly kind of a structure. The point is with some of these companies that we have seen pullback is we are seeing a much heightened competitive intensity in that sense, whether it's in quick commerce with some of the incumbents trying to make a comeback, or in fashion and beauty, where some of the larger players or omnipresent retailers are heightening the competitive intensity. So I think the issue there is about competitive intensity, then about longer term valuations in that sense. Coming back to in terms of profits, as I said, durables at this point of time looks better placed in terms of growth. So we like some of those companies, including likes of Havels or within mid caps, something like a Crompton Consumer. I still think I agree with you that probably we should see a recovery in discretionary. The growth recovery in discretionary should be much better than staples. So we own names like Jubilant Foods, which we think should be a beneficiary as and when consumption revival happens, or United Spirits, which should again benefit from the revival and discretionary consumption in that sense. So we are focused more on urban consumption, and within that urban discretionary consumption, we think that will see a faster recovery versus some of the other categories.
Okay, Jubilant Food and United Spirits. I think we must have contributed to the sales for these two companies at some point, most of us for sure. Nigel.
Well, Pankaj, I wanted your view actually on the top 2 nifty losers right now. Nigel Motors, that's down close to around 5% as we speak, and Apollo Hospitals as well as reacting to its numbers. I don't know whether, a new entrant into the hospital space, we had the news about the Adani Group making its entry out there, whether that's weighing on to sentiment as well. And that's why that name is now down close to 5%. Any view on either of these two names? Well-run franchises, some kind of softness in their numbers, but in the past they've delivered good numbers. Your take?
Well, as far as Aisha is concerned, I think the numbers are pretty healthy in that sense. So one trend which is becoming visible, Nigel, as we saw in the case of Trent as well, what we were alluding to, is probably while companies are reporting pretty healthy numbers, but probably the growth expectations that's priced into the stock is much higher. So when the Trent stock corrects, even after a 32% EBITDA growth, which essentially reflect that the stock was pricing in much higher growth at about 40% plus. So probably a 32% growth in that sense didn't sound so great to the street in the context of expectation that were priced in. I think the similar case with iShares or with Apollo in that sense. So obviously, all of these stocks have done phenomenally well over the last year or couple of years in that sense. So I think it's more of a pullback than anything, or than poor numbers in that sense.
Pankaj, just very quickly, I remember you liked SBI, right? You still like SBI, I think. Numbers from PSU banks have all been pristine as compared to private sector players. But stocks are, is it the broader market mood or is something wrong here? PSBs.
Well, within the state-owned banks, obviously we own SBI. We've liked it for a very long time now. I still think that the inherent value of the implied value of the franchise is much higher than what market is pricing, and at some point of time, market will take cognizance of that. I think this quarter's numbers have been pretty good for all of these banks, and especially for SBI, has been a pretty decent set of numbers. More importantly, valuations are pretty reasonable, and the growth outlook continues to remain reasonably healthy. I think financials within the overall market is one sector, and especially lending-oriented financials, where valuations are far more reasonable as compared to other pockets of the market. The sector, financial sector, is one of those segments of the market which is trading at almost about 25-30% discount to the Nifty index. and the sector has underperformed in the last 3 years. Asset quality is pretty strong. Hopefully, meaning loan growth should pick up going forward from the second half of next year, and that should improve the growth trajectory of these companies. So probably, I think private sector financial should do well, and within that, SBI or some of the other private sector names like HDFC Bank or Kotak Bank, which have been laggard for a while, should certainly catch up.
Okay. All right, Pankaj, got that point. Thank you very much for joining us on the show today. Good to get that perspective and advice from you.